first rates will just start kicking in any second now, and I'm just going to scan through the first rates. There you go, first rates on your screen now for the Nifty and for the Bank Nifty. It is a good start and it is a decent gap up start. The breadth is looking formidable. Formidable is the word. I really hope it sustains. The small cap index is up, the mid cap index is up. So today we have a proper bounce across the board in terms of the market breadth, and also what do we have in terms of the market setup. Now TCS on expected lines, it's a cut. It's a cut of 1%. But a organization like TCS, the succession planning, and this is not a forced, this is not a forced exit. This is a planned exit. Means that the succession planning is something which will not really have a large impact on the business per se. The only problem is that TCS has been commanding high PE multiples, and that in a sense now in the short term could get challenged. I want to revisit Infosys also and the IT index per se, and bear in mind that if TCS would have not gone today because of the news per se, then the IT index would have looked very, very different. But meanwhile, Infosys is bouncing back, Tech Mahindra is bouncing back. There is an uptick which is clearly visible in other IT stocks as well. So the strength, I think, is there in IT. The strength is there in banking. The strength is there in fintech stocks, and the strength is there in even some of the PSU banks. So a good day, Aisha. It's turning out to be a lot of green.
Yeah, and I'm intrigued by TCS. I don't know if we can bring up that intraday graph or not, because the first tick was less than 1% lower and we've recovered most of our losses in TCS. It's already back at those 3170 plus kind of levels. Samvardhana Motherson, that's looking to acquire the remainder 50% in Fitzmer Motherson Cabin for 111 odd crore rupees. That's another stock which is in focus this morning. Then, of course, there's NTPC as well, wherein reports are indicating that Malaysia's Petronas has offered for $60 million for a 20% stake in their green energy arm. NTPC has started off quiet at best. The big buzzer from yesterday, Z, which is now exploring strategies including settlement and reports on IndusInd Bank. Speculative is what they say. Z is kind of undoing yesterday's losses. Gains rather, 2.5% lower for Z as we speak, although the stock of course shot up much more yesterday, was holding up 9.5% yesterday, remember. There's Bajaj Finance as well. Anup Saha and Rakesh Bhatt have been appointed as executive directors for 5 years. HAL and Bharat Forge Defence Acquisition Council has approved a proposal worth 70,500 crore rupees. So focus clearly back at defence as a sector. RVNL once again emerges as the lowest bidder for a project worth about 111 odd crore rupees. And then Glenmark Life as well, which has declared a dividend of 21 rupees per share. Another order, 800 odd crore rupees for VATech Babag for a project in Bangladesh. These are a couple of stocks which are in focus. But IT actually is a leader sector this morning. Much unlike the case that was the past couple of trading sessions, Infi is now holding up in excess of 2%. TCS, let's bring up that stock up for you on your screens once again and show you what it's currently doing. It's settled around 31.75, which is really not that bad considering how the news flow was and how it took everyone by surprise. So I would say it's a negligible or no reaction whatsoever to the leadership change at TCS. What about the crude sensitives? That's where the trend seems to be moving. BP, HP, IOC, Asian Paints, what have you. That entire pack will just come up for you on your screens next. BP is a little softened after that 6% move on the stock yesterday. IOC holding up 0.6% and Asian Paints should come up for you on your screens next. That's an important one. But Kunal, not bad a start for the market, but again, feeble. You don't know whether we're going to stick by to 17,100 or not.
I think it's a good start for the index. I'll probably look out for going, more charged up into this kind of a rally as well as an upward trend, and I would look out for building more large cap names. So the stock which specifically I would look out for would be from the large cap front. SBI, for example, is one of the stocks which I believe could probably play out quite well for itself, turning around, going into a strong, rather it's already underperforming, but I would believe that the stock could probably catch up the major speed of the underperformance as compared to the other PSU bank majors. So SBI is the stock which I would look to buy.
It's a good looking market today for a change. Bharat Forge, Tata Motors, SBI, RBL, HAL, BL, Jubilant Food, from a pizza company to a metal company, from an auto company to a power company, everything is moving up. Dinshawarani is ready. Let's connect with him. And I can bet that doesn't matter how volatile markets are, he will be bright and chirpy. And this time it's a yellow t-shirt. Just a coincidence, or this is like you're confused, not here, not there. Red is bulls, red is bears, green is bulls. Yellow means not
Yeah.
here, not there. Yellow means volatile actually. Let me rephrase it. The new market color.
So because I was anticipating that question of yours, and I realized that since I was wearing a yellow T-shirt and it's not amber, by the way, it is either ways. You can move either ways. You can wait. You can wait for the market. Actually, we've been calling this out. We've been saying that the market's gonna be in a tight band, and a correction will be an opportunity to pick up your stocks where you're comfortable with, and a real rally, if there is one, you may just shave off a bit and then come back again, and because there's enough opportunity in this market actually, and that's what we believe ourselves to be stock pickers. So we waiting for the right stocks and the right price. And
Sharma also joined us. He was wearing a yellow t-shirt. When I asked him the same question, he said that is my idea of how I want to represent India. See, if you can see, Shankar was wearing yellow, you can wearing yellow. Like sun is shining bright.
that was a good answer.
So, have you shopped a lot in this market decline? Because a lot of news per se will not have impact on India, if at all. If I focus on crude, so what's happening in the world right now? A, it's not going to have a contagion. B, crude and commodity prices have come down, which on margin is great news for us.
So actually, Nikunj, the problems that US went through, the banks went through, it was quite ironical, right? Because 2007-8 was brought on by aggressive lending to the housing sector, which actually the bubble burst and things went downhill for them. But in this case, it was because of buying government bonds, right? So it was obvious there's not a crisis we're talking about. At the most, a Fed could have very well come back and said that, okay, guys, I will lend you the money on the face value of the bonds as such, because he's the guy who's issuing it, right? So, and that actually happened, and that's why the world is back to where it was earlier. And actually, you're right, because we did realize this, and frankly, I mean, we never panicked. We did pick out a few names. I mean, not names, rather we didn't add any new names, by the way. We've been in search for a few names, but we did add to our existing positions and never cashed out. And we, in fact, we were in cash to an extent, and we started deploying that cash to that much extent. So.
So we're never happy with just the view. We want the names as well. What is it that you bought and sold?
Aisha, no, I won't be. I won't be telling you the names per se, but I'll definitely disclose the industry. So basically, the panic was in banks, nothing to do with US, and certainly you saw a lot of correction in the banks in India per se. So obviously we love our private sector banks, and so we picked up a few names there. In the consumer space, there was a bit of a upheaval because rural seemed to be not picking up, urban seems to be on a downhill. So that's why one sees a bit of a turmoil, which we agree with also to an extent, but we don't think that's going to be a lasting effect. So there we're being a bit cautious, but we're picking up wherever we see value coming in as such. So.
Okay. Dinsha, so maybe you're not divulging too many names. So let us try and eke it out of you and just chat individual sectors actually. And wanted to get in your take then as to what the outlook is. I'm asking in particular within the defense space, because that has seen a lot of news flow of late. Some positive news as well coming in for the likes of BEL as well as HAL in today's trading session. That's a space that, y'all have looked at. So what's the interest in terms of picking out stocks within defense? And do you believe that it's a long-term theme that investors can ride out?
So we're being very choosy out here because we also believe that I won't say long term because all depend on the budget flows and stuff like that. But frankly, I mean the ones which we looked at were mainly as outsourcing plays rather than purely on the defense budget of the country as such. Though that is also a big thing to look at because you're talking about indigenization happening on a bigger scale as compared to what was earlier. But the fact is that you need to be in a sector, in a stock, which is not only dependent on the budget flows as such, but also on global flows per se. So that's why we're in a space which is in electronics, in the defense space, which is into electronics. And as you rightly know, electronics are used across the forces as such. It can be Navy, Army, or Air Force, or whatever you will. And obviously, it's a very appealing space, even on a global scale. So that's why we're being very specific here. We're not being spreading our bets in this space much.
I'm looking at the screen, and today the price action I think is very, very commendable. So, Dinshu, I'm going to address the big global concern. The big global concern was that US financial market and then the European banks will go belly up. The regulators have stepped in and they are following this approach of whatever it takes to stem the crisis. So, surely, if one has to address the big elephant in the room, which is confidence and crisis of confidence, has that got addressed? Do you think there is no fear of contagion or any bank going belly up now?
Not really, Nikunj. As I said earlier, also this time it's a different problem. It wasn't a problem where there was aggressive lending. Actually, your asset side is not the one which is sorry. The asset side is not under question out here. So basically, what you're doing is what they did was they bought into these government bonds, and as because I mean, frankly, I mean the interest rates were in such levels that a good yielding asset was a government bond per se, and that's what give them a very good return in a flattish interest rate scenario. But as the interest rates started moving up, that is where they started taking a hit. And as I said, that's a very easy problem to solve because it's a sovereign debt you've got in your hands, in your hands as such. And obviously it's a central bank can easily bail these guys out by saying that, okay, I'm lending you against the face value of the bond that you're holding. And that's what really happened. And that's why I don't think it's a crisis per se, but yeah, as you said, the confidence levels were the ones which were taking a hit. And I think the way the banks have behaved in the US also, like 11 banks came together to bail out First Republic Bank per se, and gave them a deposit of $30 billion just to tide out the run on its deposits. So I think that's a very good move that these guys are doing, and they're also comfortable here. It's not an industry which has blown up, which used to command a big chunk of their book as such. So that's where the comfort comes from.
Problem number one, there is no fear of contagion. Now let's address the second problem, which is that from inflation, the narrative is shifting to recession. Bond yields are down, commodity prices are down. So we may say, okay, bond yields are down, crude is down, that's great news. But if recession is knocking on if is knocking now, that means that the second half we could be in for more earnings downgrade, more disappointing economic data, and then what will happen to a market like India, which is a premium market?
So, Nikunj, if I were to share some data with you, in the last 50 years, this inversion in the US has happened 9 times in history in the last 50 years. Okay, 8 of these times it has led to a recession. The ninth time which is yet to happen, is October of 22 when the inversion happened. But the good part is that the last inversion was in 18, and there was a recession which came in, but it was a very limited time period recession. And the only comfort that you take away from that is that Mr. Jerome Powell was the Fed chair even then. So that he knows the battle. He's fought this battle. He's won it earlier. So that's one comfort level coming in here. The second one is the fact that we're looking at so the recession had to be called out, right? Because the inflation, the way it was running away, I think the Fed also was looking at it. But the silver lining here is the way the banks are now getting stressed in the US. It's obvious that the Fed also will, take a backseat and say, okay, I've done enough, I think. Let me wait for the data to come. In fact, the retail data, which has been coming out on a monthly basis, last 4 months, 3 months have been negative in the US, the retail data as such. So it's obvious that they are already in a recessionary cycle. I think he needs to limit it to that extent. So maybe that is what is happening. He will not call out a 50 bips hike. Europe did, ECB did as such, but then they were very, very much behind the curve, right? At 10.5% and 3% of interest rates. I mean, come on, 10.5% of inflation and 3% of interest rates. I mean, there was a no-brainer there. So I don't think it's going to happen here. Even on the inflation front, they're somewhat in control, though too far away from the comfort levels of 2%. But I don't think it's going to be a panic situation going forward. And as you rightly pointed out, recession is around the corner, no doubt, in the US. But in India, I don't think that's going to happen. Our belief is that even RBI's rate hikes were not to control inflation. It was mainly to counter the US Fed rate hikes and manage the rupee per se, rupee USD depreciation per se. So that's what was happening out here. And even here, though there may be some kind of crisis of confidence in the sense that retail may take a backseat per se, but look at the way the capexes are kicking in as such. I think that's going to work out perfectly for us.
had interesting new sort of notes and observations on the entire India urban consumption patterns, right? I mean, everything from a Vedant fashions to campus footwear, or for that matter, even lemon tree. Tell me, in the current macro environment, do you see the rich tightening their purse strings? Because, I mean, data doesn't seem to be indicating at all. We just heard from DLF yesterday as to how their new premier property is already selling like hotcakes.
Right. So 8 crore ticket size, 1100 odd units sold. I mean, 8,000 crores in the kitty. See, these are mind-numbing numbers, right? So the fact is that I don't think the rich are impacted as much. In fact, even today, you can hardly find any. There are luxury watches as such. There's still a waiting list for all the luxury cars and also. So I don't think that's a segment. Anyway, that wasn't the segment which was moving the ticket in India. It was mainly the mid and higher mid income which was really doing the job out here. But the fact is that, yeah, I mean, this segment itself is going to grow, right? And that's where the call is. So maybe in the short term, maybe one may see some kind of a small downtick or something in this space. But the fact is, on a longer term basis, medium to longer term basis, this is a space you need to be in, because if you're calling out that India is going to be the third largest economy by the turn of this decade, then obviously this is the space which is going to be the one which is contributing to that, right? So that's why you need to be there on a regular basis. In fact, look out for your ideas, and as and when you see some opportunities, get into them and keep building up your positions.
DLF folks were, in a sense, indicating that this time around, a lot of ultra HNI investors from Bombay, especially from market, have bought place, have done a booking there. I'm just saying it. I'm not saying you bought it. I'm just telling you.
Okay.
Why you
So
not
even
reacting?
I heard that. I wasn't the one.
I'm just saying it. No names.
Come on, Nikunj. He's not HNI. He's almost an FII.
That's ultra
Right,
HNI.
Dinshaw?
Ultra HNI.
I'm sure
Net
Nikunj
worth
was the
wise.
Dinshaw, but is there merit in buying real estate? Because typically, if we are going through a shakeout, and if there is a bit of an volatile environment for equities and for financial assets, real estate and hard assets, they come back. Money could move away from equities to real estate, from equities to fixed income. Is there merit in thinking on those lines?
Nikunj, there may be some merit here, but the fact is, when a rising interest rate scenario, you normally stay away from interest rate sensitives, and these are interest rate sensitive because you're talking about big ticket EMIs out here. I mean, as in whenever there's a slight hike in interest rates, the outflows also increase to that extent too, because most of the lenders were telling us that they're already at 15-year tenure level. So it's now EMIs which are going to go up and not the years of payment coming back to them. So the years of EMI, sorry, coming back. So that's why I believe that this is a space where you have to be very selective. In fact, we've been very selective out here. We've just got one single name, which is a metro-centric company, and obviously there's a mix of retail, a mix of rentals, and stuff like commercial rather. So that's what we're playing here. And because anyway, the commercial part also gives up as the interest rate cycle moves up. So that's what we try to hedge out here. And that's why we've been very selective.
You don't own IT. But is it the time when you should revisit IT? Because most of the IT companies have said that, look, we've got no problem with what's happening in the world. We don't have exposure to the banks where there is a problem. Now that if your thought is that banks will not have a big problem and IT stocks have sold off because of that concern, so if the concern is not real and prices have gone down, isn't it this time to revisit them?
Not really, Nikunj. I think this is the time you need to be. In fact, any rally you should use to get out of IT per se, because our belief is that, in fact, if you look at the sound bites also which came out of NASCOM, they weren't very gung-ho about it. In fact, after seeing a dip from 19 odd percent to 11 odd percent, they're still talking about a slowdown in FY24 as such. In fact, the year of excesses is coming to normal. I mean, that's what the word they used as such. So obviously that is one area of concern. Secondly, if you look at the recent surveys that are being done by CTOs, it's obvious that they're looking at cutting off. In fact, if you now talk to some of the IT players, you'll yourself realize that they're getting more and more cautious as what they were 3 to 6 months back. And obviously, one is going to wait very anxiously for what Infosys declares in the March end and gives the guidance for the year as such, we don't believe it'll be more than any mid-single digit kind of guidance as such. And frankly, I mean, if that is the way it's going to be, your valuations might as well come back to the pre-COVID levels when anyway the growth rates were mid-single digit kind of growth rates per se. And that, you know, that they are still around 25 to 30% away from those, even despite the correction that one saw in the IT sector.
All right, Dinshaw. Appreciate your time. Thank you for joining us, and keep that smile going, Dinshaw.
Always a pleasure, Nikunj. Always smiling for you.
Gautam Shah joins us now, and Gautam, looks like bulls are smiling today, but who will have the last laugh eventually, the bears or the bulls?
Well, I guess the trend will have the last laugh. I think we've been in this downtrend for the last 2.5, 3 months. It's been a very classical downtrend in every sense, with just about every parameters in favor of the sellers or the bears. 16,800 was our working target on the downside. You know, it was the previous low. It was also a point where multiple supports had kicked in, and I had spoken about it in our last interaction as well. So yesterday you had a sort of a mini selling climax with the Nifty going close to 16,800, and from there we've seen a bounce. So I think whatever has happened is very normal. Even the bank Nifty has reversed from the 38,500 level. And we've seen these bounces a few times in the last couple of months, and they've just acted as a trap. You know, people hope that it's a bottom, but it does not end up being a bottom because the markets go on to make a lower low. So I would remain bearish. I think this is just a short-term pullback that will get sold into at higher levels. 17,100 and 17,300 are very important resistances. I don't think this downtrend is going to resolve in a hurry. Eventually, 16,800 is likely to break, leading to another 4 to 5% downside at least.
So trend will have a last laugh, but the point is that trend is something where we are debating right now, whether it is 16,000 or whether it is 15,000. So what is the trend? Are we in for volatile times, or are we in for a linear decline? Because Gautam, that is the difference. That volatile means that you will keep on going up and down, and a linear decline means that we'll fall and will continue to fall.
See, Nikunj, every downtrend is different. You know, you can't compare the downtrends of the last 20, 25 years to what has happened in the last 18 months. Because in one sense, the mid caps and small caps have been in a downtrend since October 21. It's just that the Nifty made a new high at 18,900, you know, in November, December. And therefore, you can't call it in a bear market or in a downtrend. But I think the trajectory will remain down. It will be volatile. It's not going to be a linear decline because we live in a very dynamic world where too many things are happening on a daily basis. So you will see a lot of volatility, but the sequence of lower tops and lower bottoms will continue. So I think that the trend is clearly down. Pullback rallies should be sold into. This has been the stance for the last 2.5 months, and this remains. So do not get carried away with the uptick. I think that's the advice that we are putting out to our clients as well.
Gautam, just wondering what's going to happen to the weak pockets in the market right now, and perhaps you can help us identify that a little bit better. And you know, just because TCS is in news, we were just taking stock of how some of the IT sector constituents have performed. The fact that Infy is just about 4% from its 52-week low, has the time come to buy into any of the IT names? Do you even foresee any kind of rebound, and a meaningful one at that, coming anytime soon?
Well, the IT index in India witnessed collateral damage on account of the developments around SVB in the US. I think it's very clear because before this news flow, I think IT was relatively stable, and there seems to be a knee-jerk reaction on account of that in the last 1 week. I think it's temporary. I don't see much downside for the IT index. In fact, I do believe that it bottomed out a couple of months back. This is a buying opportunity from an investment perspective. So go out there and create those long-term positions in IT stocks, large caps, mid caps. I think we like it across the board. And the other two pockets of the market that we like is PSU and capital goods. So these are the only three pockets that we like. But in terms of the weaker names, you know, we are still very bearish on the bank Nifty. I think our eventual target is 37,500. We are very bearish on Reliance. So far, it's all moved as per our review, and we do believe that eventually a stock like Reliance can move towards 2050 and lower. And metals, obviously, you know, after the washout day that you saw yesterday, I think it will see much more pain. So, you know, there are pockets in the market where you can play strength and weakness while the Nifty oscillates in this 16,800, 17,300 kind of a band.
Gautam, hi. What's the view when it comes to those defenses? Because FMCG, you said, is in a downtrend and pharma at new lows. So what's the strategy right now? And if you'd like to share any names, more than welcome.
Well, see, defensives, seem to have gone out of favor to a certain extent because I think it's more of a debate between growth or value. I think the market has moved into value, which is clearly visible given the way PSU stocks have behaved in the recent past. Pharma obviously is making new lows. It's clearly not a defensive from a market's perspective. You cannot hide in the pharma stocks. And FMCG, if you look at the index, it's just one stock, ITC, which is holding the entire index. And aside of ITC, every other chart in the FMCG space has been quite weak for the last 3.5 months now. So I don't see any strength there. And even ITC is looking a little toppish around that 380, 400 zone. I don't think it's going to get past that number in a hurry. So again, I would be bearish both on pharma and FMCG. I think they should be sold into even at these levels.
In 2023, the remaining next 9 months, do you think more gains would be, more money would be made by going long or by going short? A very basic question.
Nikunj, I think more money will be made by going short. At the same time, this is going to be a trading market. You know, at the start of the year, I made this comment that if we are just going to be confined within 16,000, 19,000, we are doing very well for ourselves. But now there is a scenario which comes up and says that maybe we might even break 16,000 at some point of time this year, not immediately, at some point of time. So the best case scenario is we stay stuck in a range. And therefore, I think the rest of 2023 is going to be a stock pickers market because mid caps and small caps have outperformed on a relative basis. I think we just need to accept that. And there will be some pockets, that will stand out going forward once the Nifty and the Bank Nifty stabilizes.
Spoke about gold. I distinctly remember your words were 18 of viewers should buy gold. It's done reasonably well. 5-6% up. That's a very decent return for gold in what matter of 6-7 weeks. Do you think another 5-7% for gold is coming?
Easily. I think the beauty about gold is that anything happens in the world, on the negative side, gold is the first to go up. And we've just had too many developments in the last 1.5 years, or rather since the COVID times. And with this development around SVB, we've seen this $100 move on gold. It's already at 1915, 1920. I think it will get past 1970 in the near term and eventually move past lifetime highs of 2017. So there is 7, 8, maybe even 10% upside on gold and about 15 to 17% upside on silver. And we strongly recommend topping up on both these precious metals at current prices and on any small decline.
Where do you see strength in the market, Gautam? I mean, I know you want to short the index further, but where is it that you foresee that the sectors could be a little bit more resilient to what's going on overall in the markets?
See, Aisha, last year when the Nifty went towards levels of 18,900, there were a lot of contributors on the way up. A lot of stocks did well at the same time. But now when I look at the top 12 stocks, I just get the feeling that not 1 out of 12, has a strong medium-term chart, barring maybe an ITC and to a certain extent Bharti. Everything else, basically has a negative setup. So when there is no leadership, there is no participation. And if you were to do a sum of parts kind of an analysis for the Nifty, you don't get the confidence that the market can actually sustain at high levels. And if you really look at the reverse side of it, if all of these stocks are negative, then there are just too many stocks pulling the market down. And that's why I think we got to 816,800 yesterday. And possibly at some point of time, we will break that as well.
I'm going to just do a chart check with the top 3 weighted stocks, Gautam, because that will define which way things are moving. Number 1 weightage, Reliance. You said that you bearish on Reliance, but the stock is at a 52-week low. So can it slip further? Can it go back to what levels?
I can actually go very lower, Nikunj, because I think in the last 1 year, in the good times, Reliance refused to participate. Number of times it got to 2,700 and just corrected from there. And this activity of the last 1 month is actually quite bearish. And it's the weekly and the monthly charts which have got quite negative. So our working target on Reliance is 2050. But I wouldn't be surprised that if it even goes below levels of 2000 and eventually maybe even tests the level of 1850, 1900. So that's a large 10% kind of a fall on a stock which is 11% weightage on the Nifty.
Heavy weight is HDFC Bank. It has not been a complete, it's a stock which has underperformed, let me put it this way. So what are the chances this will fall less?
I I think it will fall less because anyway, I think to a certain extent it's under-owned now. Till a couple of years back, when the ICICI Bank versus SDFC Bank story played out, ICICI Bank became over-owned and SDFC Bank became under-owned. That's what we feel. And given that, I think SDFC Bank is a good place to hide. If you're a long-term investor and you want to protect your portfolio with falls of 15, 20, 25%, which is happening in many other stocks in the market, SDFC Bank and SDFC fit the bill. So it will be a market performer, but it will not see great downside from these levels.
Wait, is Infosys.
Well, Infosys, I would be positive. I think, as I said, I'm positive on the IT index. I like Infosys and TCS. I think this fall is a little overdone, is more sentimental in nature. And closer to the 52-week close, I think the risk reward is very lucrative to go long. So probably IT is one basket that will try and hold the market, every time it comes close to support levels.
If I put a gun to your head and say, Gautam bhai, no sell calls. You have to buy a stock. And there's a gun to your head. What would you say? Shoot me or you'll give me a name?
No, there's always a name, yeah. I think, so I would say L&T. I think capital goods has been our favorite all along. I see it as a 3-year, 5-year story. So these market dips are a great opportunity to buy into capital goods. Look at what Cummins has done, ABB, Siemens, L&T. I think they are great buys from a long-term perspective. The moment the market stabilizes, these stocks will start making new highs once again.
Saying this because there is a gun to your head, or you would have said these names if there was no gun to your head also?
Only because there was a gun to my head.
Okay, I'll remove the gun now. Now tell me the names.
Pretty much the same names, Nikunj, but I would also add the PSU names. I think we like the setup of NTPC, Coal India, Power Grid. I think I love the way these stocks have behaved in these difficult times. There is earnings, there is dividend yield, there is under ownership. And I think they could do really well.
Okay, no gun on your head, but I'm glad that we at least got some of those names out, and more importantly, got in your levels on some of the heavyweights. That, of course, gives us some sort of a direction as to where we're headed. Gautam, good to have you on board. Thanks very much for joining in. Let's identify some of the movers in the markets then. And as things stand, you've got the index quoting at about 17,076 levels. It's the mid and the small caps as well that are holding out comfortably. And KPIT Tech, Greaves Cotton, DLF, HAL, Aurobindo Pharma, those are active in trade. Quick break, be right back. Back with first trades, and some of those defense stocks, they're a buzz. Remember, the Defense Ministry has approved that proposal to acquire those weapon systems worth about 70,500 crore rupees. Z Entertainment has reversed those gains, and a quick check-in on the stock of the day, I think. That's TCS after the big step down, end of an era. It's about 31.56, so down close to 1%. Let's move right on then. And crude oil prices have definitely been in the spotlight as they tested that level of $75 a barrel. Let's connect with Mr. M.K. Surana, the former CMD at HPCL, to talk a little bit more about the crude oil price trajectory as well as the implications on some of these companies and the demand situation. Mr. Surana, thanks so much for taking time out. Given the kind of demand concerns we've seen owing to the fall in US banks and the higher inventory levels, we've seen crude oil prices been vacillating quite a bit, and they've dropped nearly 13% from the recent peak. I just wanted to get in your thoughts on how crude oil prices have been moving.
Good morning to you. As you rightly said that in last 2 days, there was a fall in the crude oil price. Almost it came below $75 level, and today it is hovering around 75. And the reason is obvious that two things. One thing was a hawkish Fed commentary, some data on the inflation, and of course the turmoil in the banking system, which gave a concern. Of course, the positive side was the China demand picking up and the optimism about that, but little bit of uncertainty regarding how fast and how quickly the demand in China picks up. And that has led to little bit of cautiousness on the market, on the part of the traders and the speculators. And that has led to the fall in prices. But in a larger commentary, if we see the most of the inputs are digested in the crude prices, which has brought it steadily down from a high of 127 to let's say 80, and for some time it was hovering between 80 to 85. But I think that it is now veering more towards 75 rather than 80 to 19 trajectory. Maybe there will be momentary spikes because of the news flows coming on day-to-day basis. And going forward, it will be seen that how fast and how quickly the demand picks up. But I see that it is trying to settle more towards 75 rather than above 80 now.
Mr. Surana, in India, despite the fall, OMCs have refrained from changing retail fuel prices, right? This is also because they have suffered huge losses earlier and they're now trying to recoup the same. How long do you really expect this to continue?
No, in fact, the reason for OMC is to keep the prices constant for almost now more than 7-8 months, even when the prices were very high. And that the obvious reason were debated substantially in the media and otherwise also to control the inflation, to insulate the consumers against the volatility of day-to-day changes, etc., etc. But at the same time, OMC have also suffered a little bit because of this, and their bottom lines have got hit, as we have seen in the quarterly results which came earlier. And therefore, there will be a reason for them to hold the prices even if it goes below, to at least recoup part of the things. And therefore, I think it is reasonable to expect that there may not be a sudden fall in the prices just because the crude prices are falling. That is one thing. But the second thing, we also need to be conscious that while the crude prices have fallen a little bit, the cracks have not fallen to that extent, though it came down from a very high level, which was there in between. But still, the diesel cracks are somewhere around $26, or MS cracks are somewhere around $16, and the dollar prices are high. So I think we should expect the prices to remain in this level for a little bit more time before it comes down. One more aspect which we should remember that while the crude prices come down only in last 2-3 days, but the prices are determined based on a rolling average of 15 days, and therefore it has to remain at a lower range for a longer time to see the impact of it in the pump prices.
Mr. Solana, so what should be the right spirit when fuel prices, when crude prices, they went higher? Oil marketing companies had to play the role of a good corporate citizen, and then they were subsidized. Now oil prices are going lower. Do you think they should be allowed to make profit, or they should pass it on? What should be the right spirit?
Okay, in absolute terms, if you ask me, it should be purely market determined, but that is a perfect market and the perfect social system. But we are not in a perfect world, let's accept it. And therefore, there will be regions which becomes uncomfortable both on a very low side as well as on a very high side. And therefore, we should expect some sort of moderations in the price levels and not remaining perfectly market driven whenever the things are going out of a boundary. I think the right spirit will be that in a range, it should be purely market driven. And if it is beyond the range, there can be modulations, but every high level modulation done, which will impact the OMC, should be compensated by a lower regime moderation again. I think that will be the correct way to go.
Okay. Refining margins, inventory loss and gain. So while we can focus on one part that oil goes down, it's great news. But on the other side, there are inventory adjustments. There is going to be change in refining margins. So good will cancel bad and bad will cancel good. Bottom line, nothing changes incrementally for a shareholder.
I can't say that, and I should not say that also, because all said and done, there is a steady. If we leave aside the last 3 quarters, the oil companies have made profit consistently. Let's accept it, and the profitability has not been bad also in last few years, if you say that. Now, the total sum is a combination of refinery margins, the inventory gains loss, the marketing margins, the market moderation, supply demand, everything put together. But the oil prices, if they are continuing to be the same range, if the cracks are remaining to be in the same range, then what is changing? The changing is the inflation and the normal pricing level. So the profitability growth comes by the expansions, by the efficiencies, by the cost optimization, and that is what the companies have been doing over a period of time. So there had been expansion, there had been cost efficiencies, there had been optimization in the operating costs and the logistic costs and the way of processing, the lower carbon processes. Now, the negative impact also came because of we have got more and more stringent on the product qualities, and every improvement in the product quality actually costs money in terms of OPEX, in terms of CAPEX. And therefore, the to say that there is no gain to the shareholders would be correct, because over a period, India has definitely built up its refinery capacity, and that has come not by generating additional share capital from the market, but by plowing back the money which has been generated by the oil companies themselves. So, and they had been giving the dividends to a reasonable extent. Now, the pure market capitalization is a function of many things which you know better than me. But I think in an expected return basis, I think the oil companies have not been bad for a long-term investors. And as far as inventory gain loss are concerned, over a period of time that actually get adjusted, because these are more the book losses and gains which we have to book because of the period ends coming in between. Had there not been in period end accounting, then probably the inventory gains loss will make no impact at all.
Okay. So, Mr. Surana, let's address purely from a shareholder standpoint.
Yeah.
These stocks are cheap. They're trading at P multiples of sub 10 times. Dividend yield is strong. What should shareholders expect now from here? Investors, shareholders, investors. I mean, the last shareholder is government, so I'll keep that part aside. Let me interchange the word shareholder with investor.
Okay. So let's talk about leave aside the promoters and the government, but let's see the normal shareholders. I think the last few months, or let's say year or so, had seen a substantial turmoil in the oil sector. But the worst seemed to be over, because the oil is not looking at going above 100 or even 90 now. The cracks are not looking at going to $70 or $60 or something like that. The cracks are not going to a low of $2, $3, $4 also, which we have seen. So I will assume that the refinery gross margins will be in the positive territory, and $15 to $60 cracks is a good and reasonable cracks on MS and HSD. If that is maintained, then the refinery margin should be reasonably good. The second part is, if the crude prices hover in the range of 75 or 70 to 80 range, and the cracks are in the range of, let's say, 14, 15, then the marketing margin should also be healthy. And therefore, I would expect that from here onwards, the oil companies should be able to do better than what they did in the last 3 quarters or so, which had been not so good because of various reasons, predominantly because of the under recoveries. And if the dollar is also stabilizing, which appears so, in that case, I think that there is a reason for investors to be happy going forward. That's one aspect. Second thing is, some of the companies which will be adding the capacities, that should help. The LNG prices getting moderated should help in also the oil gas switch which was happening, that will also get a bit more stabilized. So I think the worst part is over, and future we should be looking better now.
And always a pleasure chatting with you. Thank you so much for joining in today.
Thank you. Thank you so much.
Okay, that's the word coming in on OMCs and how they are going to move given the cool off in crude. For the market, we are holding on to the gains. No, we're not. We've cooled off quite significantly. So again, that same theory plays out, wherein you are seeing the upticks getting sold into. 17,055 is where we're currently at, after having started off the day above the 17,100 print. We'll take a very quick break. Let's see where the market actually pans out from there. The Nifty Bank has fallen almost about 1% from those opening highs. So I think that is the one which is really dragging and weighing heavy on the indexes. But here's the exclusive chat that Nikunj had with TCS outgoing CEO Rajesh Gopinathan and the CEO designate Krithivasan.
Rajesh, even though TCS has enjoyed a very stable quarter, it has a very stable leadership. The timing of your exit, Rajesh, is something which perhaps is making everybody slightly nervous. At a time when the IT sector is getting bulldozed and concerns are there in the US BFSI space, do you think this timing could have just waited?
Nikunj, if you look at it over the last 10 years, this is probably the most stable time that we have seen in many years. Think about the financial crisis, think about the pandemic, think about everything else that went on, the war that was started off last year. So this level of volatility, I would say, is par for the course. And yes, there will be some ups and downs. So that definitely is absolutely not a question. In fact, in times of crisis, we have always come together and absolutely stood together as a team. And then when I was reflecting in terms of what would be a good time, I felt that there's no better time than this. And also it was important to do this before the start of the new financial year so that the incoming CEO, in this case, Krithi, has that full runway to play with it. So from immediacy perspective, just before the start of the year so that the whole year can be owned. And from a slightly longer term perspective, we have brought the volatility of the pandemic to a fair state. We have registered very strong growth, first bouncing off the pandemic lows with 15%. And then over the last 9 months also, we have still grown at 14.8% and crossed big milestones. We crossed 7 billion and we are now at a run rate of 28 billion. So when you look forward, I don't think there is going to be another period where there will be significantly difference in that stability for it to be. So it goes back to that question that you asked it, why now? And I asked myself, if not now, will there be a better time? And the frank answer was, I couldn't think that there could be anything better. And therefore, it made most logical sense.
So Rajesh, the immediate follow-up question is, when did you inform Chandra? What was his first reaction? And how did it go through? And what is next for Rajesh Gopinathan now? Everybody's curious about that. So I'm blending two questions into one.
Yeah, in terms of, I've been having discussions with Chandra off and on. And of course, when there is an immediate problem, we always focus on that. But in moments of retrospection, I've always been telling him that, at some point I want to do it. And so that's been an ongoing dialogue. The immediate one was, of course, that, as I said, and I think this is the way it happens with everybody probably, that one day you get up and then you say that, okay, we have thought about it and spoken about it long enough. It is better to, pull the trigger, as it were. So that happened just a week or so ago. But it's a conversation that has been ongoing. What next is first, I have to make sure that the transition happens smoothly. And with Krithi being there, I don't think that is a challenge at all. But I owe it to all our customers, all our colleagues, our employees, and all stakeholders to make sure that I am there for whatever time that Krithi needs. And if nothing, it might be even symbolic. But I definitely have no plans to skimp on that and will be available to Krithi 100%, not just during this transition period, at any point in time in future. After that, I want to take some downtime and spend some time with family, sit back and then think, many ideas are there. But now that the trigger has been pulled, I need to start crystallizing what those are. And it would not have been appropriate for me to go down that path while I was doing something as important as this, and which required more than 100% of my attention all the time. So that's the plan. So probably we will get to catch up and have that cup of coffee that we have been always talking about. And I am looking forward to some downtime.
We don't expect any dramatic change in terms of how we are going to reorganize. And in terms of priorities and strategies, as I mentioned before, what we would focus on is the core principle, like strategy and priority we'll tweak as we go along every year. The core principle is work closely with the customers, ensure look out for what their needs are as proactively as possible, go to them with the solutions, and work with our associates who have been the bedrock of our success, and go meet all of them and ensure how well we can. See, they are a great set of associates we have. In fact, our role is to ensure we remove the hurdles in front of them so that they perform very well. So that's what we'll continue to do. I don't expect, or you should not expect, to see a great strategy change or organizational change coming in future immediately.